Concern over China's economic recovery pressuring oil prices today. We had crude pulling back after recording 7 straight weeks of gains. Despite today's pressure, though, oil still holding above $80 a barrel, and demand expected to remain at high levels for the rest of the year. So where are prices headed? We want to bring in Bill Baruch, president of Blue Line Futures. Bill, it's good to see you again. So here we are, just above $82 a barrel. Lots of forecasts out there about rising demand, the fact that it's not going to stop anytime soon, at least for the next several months. What does that mean for crude prices?
You know, they're hanging up pretty good. I think the real underpinning right now is first Saudi Arabia and Russia. They've come through and cut production. They continue to at least do that for at least another month or two from this sort of secondary cut. Data at the end of last week also showed that Russia did cut another 50,000 barrels per day. And that got them in line with where they're supposed to be producing. There was a lot of fear that Russia was going to be overproducing. And although China's weakness is front and center, the Chinese yuan weakening because of that, it's really weighing on the metals complex. It's weighing on energy too. But thing is, China continues to import crude at near record levels. So, you know, they're despite the weakness, despite the slowing growth, they are there right now. I think the fear would be if we continue to see weaker and weaker growth, that would taper off. However, I'm on the other side of that trade, and I think that China picks up a bit, and this is some of the worst news being priced in.
Yeah, I mean, Bill, having said that, what do you make of the reaction to some of the news that we've gotten from China on the economic front? I mean, it was just last week we've heard from the IEA saying that China's demand has surprised to the upside, and yet there seems to be this constant concern that kind of percolates into the oil markets about how strong that recovery looks like.
Yeah, I mean, that's why we had oil markets at near multi-month highs and setting near multi-month highs. $83 was really an upside target for us. That now we're going to see the market consolidate a bit, and I think tonight's deluge of economic data is going to be crucial. We have fixed asset investment. What we need to see, though, is really some stimulus to help get them off the ground. And I think we could be close to hearing something. Obviously, the hanging property fears, Country Garden, the news again from them was weighing on sentiment coming into the U.S. hours. So there's a lot of things here that are boiling. But you know, at the end of the day, the best and most simple way to look at it and what all this means is the Chinese yuan. And the CME Group has a Chinese yuan contract. It's the USD CNH. So it shows as it rises, it's melting higher right now. It means the dollar is strengthening against the Chinese yuan or the renminbi. And it's back at levels going back into the early or late part of 2022, was it? Yeah. And that was that's basically them exporting deflation. If they're exporting deflation, I mean, ultimately their currency purchases less commodities, and crude's been able to muscle through things because the U.S. growth has remained steady, and the demand from China remains steady. But the metals complex has been pretty ugly, because of it.
Bill, what's your outlook for U.S. production? We just had Rick talking about that just a moment ago. We have certainly seen a recovery. Obviously, oil producers want to capitalize on the rise that we have seen in crude prices. But what do you think that future growth, how much growth could we see within that?
Yeah, I think right now we're starting to see that production pick back up. You got to think about it from the producer standpoint that, that multiple times in the last couple of decades, as we see production pick up, the prices go higher, production comes back online, and it races back online. I think right now is a unique position where you have Saudi Arabia pulling back production. You have Russia in the situation that they're in and actually following through with some cuts, although there's more, probably in the supply. But right now, I think the fact that it is a unique position where prices have come off and consolidated very well, and I mean maybe these energy companies could really hedge pretty well, but they're able to produce here at these levels and really not disrupt the price because of what OPEC's done and trying to be a bit under the price ultimately. So I think here you're getting the Permian has been producing quite a bit more. If you go through some of these earnings reports from these companies, like Chevron is producing the Permian at their highest level. So I like to look at it as some opportunity for these companies and investing in companies that have low cost Permian assets or good margins in the Permian, because that's where that's where the production is going to come from. But also at the end of the day, there's the entire space has seen tremendous underinvestment, and that's what's going to be the longest driver, steadfast driver in higher prices, because there isn't been much investment. And your prior segment, you're talking about a Biden, in the Biden administration not really being able to talk about the production coming back online because it's sort of against a lot of the narratives they've discussed. But really, the production's it's because of those narratives is we've seen the underinvestment, and that's what's going to underpin prices. And if we get steady flows from the Permian and other places here from these companies, I think it's not going to disrupt price. So that's where I really like a lot of these energy stocks right now.
Bill, that raises the concern what this all means for these energy companies, particularly big oil names, for their trajectory moving forward. I mean, we're talking about where oil prices are, but as you said, that the long-term trend is underinvestment. ExxonMobil themselves have talked about sort of low carbon being a big driver in the future. I mean, how do you look at that side of the investment? It feels like that was more front and center last year in terms of conversation, but those investments are continuing in the back.
Well, last year was a reality shock. When Russia invaded Ukraine, it really was a reality shock that energy runs the world. It really does. If you look at every product, from lip gloss to keychains to just different things that you see around, the plastics. I mean, shoes bottom, soles of your shoes. Everything is coming from petroleum. So, and I think that became a big reminder in how important petroleum is not only in what producing the products, but heating your home and going from place to place and fuel. I think that was a reality check, and the fact that how quickly those costs drove higher. Everybody realized it's an inflation problem if there's this much underinvestment and the world is not ready to move away from it. So I think, again, that was a reality check where we came into this year, or came from last year coming into this year, and now you're starting to see production come back online. There's incentives for some production to come back online. But again, coming back to a lot of these companies, if you look at a lot of these, if you sift through the earnings reports, one of the themes was the revenue's down, but these companies were beating earnings, though the revenue's down because of the price of oil. Now, if the price of oil goes higher, these companies, the margins are going to increase. The free cash flow is there. It's going to increase. I think these companies have put themselves in a tremendous spot, and they're not just flooding the market with oil. They're bringing it back. And that really brings me to the resource life of these assets that they're drilling. I mean, the resource life has basically been halved. You go back the last 10, 15 years. So they're getting less oil. Ultimately, there's going to be less lifetime in these, and they're going to have to find other ways to get it. So it's going to keep the entire landscape very tight for the foreseeable future.
All right, Bill Baruch, we have to leave it there. President of Blue Line Futures, thanks so much.